Good evening, the ICSI functionaries, CS Amit Gupta, CS Pradeep K. Devnath, on the dais, co-speakers Rajiv Singh, Inspector Dr. Naran, other members of the profession. It gives me great pleasure to be here, to be invited by the Institute of Company Secretaries. Thank you, sir, for the kind introduction. The only thing which I am not, cannot gracefully accept is the fact that I am still not a member of your esteemed profession. I think perhaps you mistook for my father. He is a member of the Institute of Company Secretary. But thank you very much for inviting me all the same. I know we are running behind schedule, and I have a presentation which I have shared. So what I would like to do is, because essentially on the accounting, what I'm going to do is to basically cover the concepts. I'm sure you may be aware. If you are not, please feel free to ask. So let me understand. What is it that we understand about accounting for M&A transactions per se? Anybody? I mean, what is it that is specific? There's not too much. Whatever is not perfect. So would anybody like to just comment so that it helps me to take this session forward? Anybody would like to share what is it that you understand in terms of how you account for the M&A transaction? Is there an accounting standard prescribed? What does that say? Any thoughts? Anybody? Any? Nothing? Okay. So let's just look at the various scenarios in which you can acquire stake in a company. So if you just look here, the first is that you merely take as an investment. So anything below 20%, right, will be taken as an investment, and you will account for it as per accounting standard 13 on investment. So if it's a current investment, then it's lower of cost and fair value. If it's a long-term investment, then it will be taken at cost. The moment you go over 20%, that's where the other accounting steps in. So then you technically have an associate. So anything above 20% is an associate. So you do equity accounting. If you go into a 50-50, which is a joint venture, so technically you can have, I do understand the legal parlance, you have joint ventures where you can even have 24% and 76%. But for accounting purpose, a joint venture is where you have joint control. I will cover that joint, just briefly. If we have time, I'll just cover the various kinds of joint ventures. So you have a joint control, and you will do a proportionate consolidation. And then, when you acquire control, when you have more than 51%, you consolidate with a drawing up a minority interest. So this is the way the investment flows, and the biggest one is when you acquire the company. So this is when you are still have your own company and the other company is in existence, and then when you acquire, you merge, which is what is called M&A, or the 391, section 391 to 394 transactions. There you have an accounting standard which is AS 14. Accounting standard 14 on amalgamations, which is a fairly old standard. I will cover that because that's the only thing we have. I will also cover what are the problems we have with that, and briefly touch upon, because we are moving to an IFRS regime. So briefly I will cover what are the changes which Rajiv ji also mentioned. Very briefly, what are the changes which are envisaged in the IFRS regime. So as I mentioned, you have AS 14 for merger amalgamation, which is amalgamation essentially. You have the accounting standard 21 for consolidated financial statements. You have AS 27 for the joint ventures. You have AS 23 for assets. I don't think I'll touch upon, I'll cover because we don't have time, and these are basically operational aspects. I will cover the accounting aspects more detailed in the merger standard. And then you have the business combinations, which is IFRS 3 or IND AS 103. Incidentally, Ind AS got notified just yesterday. These are converged IFRS standards in India. So that this we'll just talk about that briefly. So we'll move to AS 14, which is the existing standard under the Indian GAAP for accounting for amalgamations. So it says amalgamations. Now, this is the only standard perhaps in the world which talks about two kinds of amalgamations. It is a nature of merger and a nature of purchase. So anybody would if you have any idea about what would be the difference in nature of merger and nature of purchase?
Merger is when two companies merge, and purchase is when there is a transaction, a purchase and sale.
It's acquisition.
But purchase is an acquisition. Merger per se, talks about two companies coming together. Practically, there is very little difference, but accounting-wise, there is a major difference. So, nature of merger is actually pooling of interests. Right? So you don't make any, so principally the difference is, and that's the only conceptual difference in accounting here, is that when I do a merger, which is the amalgamation in the nature of merger, which is pooling of interest, I don't make any adjustment in the values of the assets or liabilities when I merge. So I will do a line by line, I'll take over the assets and liabilities into the balance sheet as they are. And the difference, if there is a capital reserve or if there is a goodwill, will be, derived from that transaction, and the purchase consideration flows accordingly. That is the principal conceptual difference. So let's see what actually happens. So as I mentioned, this is pooling of interest. Now, this will apply if all these conditions are satisfied. So you can apply a pooling of interest method. So this is basically a very simple method, very basic to do a accounting for a merger. And it is commonly used. It is commonly used, and we'll see what is the problem which arises. So these are the conditions that all assets and liabilities become assets and liabilities of transferee company. Shareholders not less than 90% become shareholders in the transferee company. And consideration is discharged by issue of shares. The only exception is that in fractional cases, cash can be issued. So there is no cash also which is coming in. So you can't, that's why the purchase is different and this is different. And the business is intended to be carried on. You are not going to wind down the business. And there is no adjustment. As I mentioned to you, this is carried out at a book value. So let us say there are two entities, A and B. Whatever value the assets are appearing in this A company will be taken over in B company, right? The consideration difference, so the consideration on the basis of the valuation difference, consideration is separate. So you may have a net asset value of, let's say, 5 crore, but your consideration is, let's say 8 crores. So the difference will go to goodwill. So there is no adjustment done in terms of the assets and liabilities. Everything gets adjusted in goodwill. And this is the basic problem in this kind of accounting. So, okay, then what else happens? As I mentioned to you, there is no adjustment made. So even the P&L account in the transferor company moves as such. The reserves also move as such into the transferee company. There is no adjustment which is done. It moves as such. It retains its color, it retains its identity. The P&L account as well as the reserves. So as you see here, the reserves are also moved in the same. Okay. Now, this is the other method, which is the purchase method. Now, purchase method is used when those 5 conditions are not satisfied. So, in the purchase method, there is an option. You can either take it at book value or you can fair value the assets and liabilities to arrive at the goodwill. So, but still you have the option. It is at your option. The standard gives you an option that you can take these at book value or you can take it at fair value. If somebody can tell me what is the disadvantage in taking the book values in such an M&A, in such an amalgamation? Can somebody tell me?
In case of book value, they will have to represent the actual value or the market value of that also. So whenever we want to purchase it, we would like to purchase it at that the fair market value, and less maybe either it will be goodwill or maybe should loss.
Yeah, so what happens is everything gets parked in a goodwill or capital reserve. The asset, when it comes into your books, is not at the value at which it should be, and it does not get depreciated as such. So that is the essential difference, and that is not correct accounting.
That is also based on the going concern transaction.
Sorry?
That is also based on the going concern transaction.
Yeah. But we're moving to a more market-oriented approach because see, if you're going to acquire a business, you're going to merge a business, then definitely you put in a higher value to those assets and liabilities, or maybe the liabilities need to be written down, or the assets need to be written down. Absolutely. That's exactly what I'm saying, sir. That's exactly what I'm saying. That because you are able to, put a fair value to the assets, you can then, it's not, everything is not parked in goodwill. The assets then come at their actual value. That is the essential difference. And also I'll cover another thing here. That if you see here, that the fair value may be influenced by the intention of the transferring company. So there may be, so a lot of times what happens is that, as you had mentioned, perhaps that that intangible. I recall you were mentioning about intangibles. Now intangibles which are internally generated under AS 26 cannot be recognized. So there is a company A which, let us say, has some customer list, it has some database, it has some other technology which it has developed in-house. It cannot recognize it because the accounting standard bars an internally generated goodwill from being recognized. Now if B was to acquire that company, B can give a value to that and actually help in getting that into the books. So that when it mentions here that the intention of the transferring company. So if my intention is to use that database as an acquirer for my own business, then I can value that, attach a value, and then take it in my books and recognize it and then amortize it or depreciate it, which cannot be done in the pooling of interest also. So this is only one of the aspects about the purchase method which is something which is positive, but there are other aspects also. Then the consideration can be in the form of securities and cash. But wherever what one needs to also note is that if there is a statutory requirement for valuation in a particular case, let us say like FEMA prescribes that you need to value, it should not be below this value. Then the standard says that we need to adopt that value. Or if it is in a BFR case, that BFR says that this is going to be the value, that will have to be the value which needs to be taken into account. So there is that restriction in terms of the statutory requirement. Okay. Now let us say I am acquiring a company, and it talks about making an additional payment if it is probable. So again, this is a business purchase scenario. I have decided upon a consideration. So I decide that I will, let's say, pay 100 crores. Now there are tax disputes which are going on, and the company feels that, okay, let us say the dispute amount is 10 crore, but they are confident that they will get that 10 crore. Right? So that 10 crore is blocked and they feel that they will get the 10 crore. So my 100 crore, I can take a view that it is probable that I will get it. So I can pay 100 crores. With some adjustment, I can say, okay, 10 crores I will park in an escrow. But I have decided the consideration based on taking into account that there is a probability that I will derive that benefit. Am I clear? So the consideration can take care of a probable scenario in future. That is what this is. So okay, let me. I think everybody may not have understood. When I decide the value of a purchase consideration, we've spent a lot of time on understanding valuation. Let us say I look at the assets and liabilities, and I say that the value comes to 90 crores. And there is a dispute which is going on where I can derive an additional 10 crores. And it is probable that I will be able to get that. So I can take that into account and add that into my consideration for payment because it is probable. That is all this is. So there is a flexibility attached in terms of deciding my consideration.
10 crore rupees will be taken as a goodwill.
Sorry?
10 crore rupees is an intangible asset.
No sir. The goodwill will be decided in terms of what is the asset and liabilities I have taken over actually. So this is a valuation for the consideration. This is the consideration. How I work out my consideration. Okay, so if my consideration is greater than my net asset value, I will come to a goodwill. And if it is less, then there is a capital reserve. That is clear? Right? Sorry? That's fine? Okay. So, what happens to goodwill? What happens to goodwill?
It has to be amortized.
Yeah, what else can be done? Sorry? What is goodwill? What is goodwill?
Goodwill is just the value of that over and above the consideration.
It's a premium which I have paid for acquiring the business. And that premium needs to be written off over a period. The standard talks about write-off amortization, and the amortization will depend on what?
Profits.
Okay, what else? Any example? I will come to what is the period prescribed, but what would it depend on?
Patent is 14 years is there.
So supposing I have acquired a technology, right? Now that technology, I'll see what is the life of that. Maybe there's a plant which is acquired, right? What will be the life of that? Supposing employees, how much is it that I can retain them for? These are considerations which I need to take into account. But the standard gives a life which is 5 years. They say that at least 5 years you should write off the goodwill. The other thing which I mentioned is what else can be done. Although this standard does not talk internationally, there is no amortization. So what is done to goodwill? Will you just carry it in your books or what will happen?
It can be carried on if we feel that this goodwill exists or that branding.
So there is the concept of impairment testing also. So you test the goodwill for impairment. Although this does not talk about, AS 14 does not, but AS 21 does. So when there is a consolidation, in that case goodwill will be tested for impairment. Which means that every year I draw up a cash flow and I see that, okay, this is the goodwill which I arrived at. Are my cash flows in line with what I had estimated earlier? Otherwise I will write down the goodwill. In any case, as per AS 14, all I need to do is amortize the goodwill over 5 years. Or it can even be longer if I can justify. Okay? So we talked about the P&L and the reserves there, not losing their identity, but here because of the business purchase, everything gets transferred to the realization account, and through the purchase accounting, everything gets mixed with the assets and liabilities, and you arrive at a new balance sheet where you start afresh with whatever profit or reserves you get, right? That is the essential difference. But in case of reserves, there are two cases where you can retain, you can have reserves different from what they had earlier. In one case where there is a statute. So as per a scheme of amalgamation, and this is where there is a huge problem which we as accountants are facing. And perhaps that is why there is an amendment in the Companies Act also, that the treatment of reserves, the standard says that the treatment of reserves, if it is prescribed by a scheme, you need to take that as it is, as per the scheme. So can somebody share, since you've been working on so many transactions, could you share any transaction where a reserve has, there is a treatment of reserve which is prescribed, which is different from what normally would be accounted for?
Valuation reserve getting.
Absolutely, absolutely. So very, very typical of a company going into before it goes into an M&A transaction, you revalue your assets. Create a huge revaluation reserve, and through the court, you get a scheme sanctioned, and the scheme says that so and so reserves are available for distribution. So you take that into a general reserve and you issue bonus shares after that, or you declare dividend from that. So that is one of, so I don't know how that will change even under the new regime and under India's, although that does not mention that aspect. But this is a challenge which we are facing as accountants. And in fact, I'll share with you, there is a requirement from SEBI also, and there is a requirement now in the standard also, where we need to disclose, and there is a certificate which needs to go. The other aspect which is also covered here is that I mentioned that the reserves will lose their identity, but if there are reserves of a statutory nature, like for instance statutory reserves, they will retain. So in a lot of, let's say in NBFCs, you have a statutory reserve which is created. Even in banks you have reserves. There are other requirements where they are reserved as under a statute. So these can be retained as they are, even if there is a purchase transaction.
And funds, which are for specific purposes.
Yeah, specific, yeah, absolutely. Thank you, sir.
Like superannuation fund, like
Yes,
funds,
yeah.
leave funds.
Actually, it talks about reserves, but reserves will cover those funds, specific funds also.
Reserves are only for general reserve, which are
Yeah.
undistributed.
No, these statutory reserves will cover that also. Will cover it. Exactly.
Any reserve for which a earmark fund is created.
Yes.
Transferred.
Can be retained as is.
Has to be retained. There is one question. Can be retained.
Yes.
Has to be retained.
Has to be.
All reserves which are created in the nature of funds which earmark security, they have been created. They have to be necessarily carried forward.
Yes, sir.
In the next one.
Yes, sir. Thank you, sir. So this I had already covered in terms of the reserves. So this is where the disclosure requirement is required, although the standard permits. And again, this is a catch here. And I will share with you how beautifully companies are, using this language. So please see, it says that in case scheme of amalgamation, any prescribe a different treatment. So normally the treatment which is different is for reserves only. To be given to reserves or transfer after amalgamation as compared to requirements of the standard would have been followed had more treatment. So then the following disclosures have to be made. So and just look at the disclosures. A description of a accounting treatment given to reserves and reason for following the treatment. Deviations in accounting treatment given to reserves as prescribed under statute as compared to requirements of the standard. Financial effect. Now I was part of a committee because the MCA was, very concerned about the M&A transactions, and they actually were very keen to bring out a standard on goodwill. So I was part of the committee which we sat down and we were there debating and discussing, about having a standard on goodwill which would cover all the M&A transactions. And one of the reasons was that companies are using this to say that if they have disclosed this, then they can get away with anything. So they will get it sanctioned, disclose it, and then get away with it, and then say the auditor does not need to qualify. So that was the whole. So the issue came up in that committee and was debated, and what we concluded was that no, you may have disclosed, but it is incorrect. So the auditor is, still bound to, if he feels that the amount is material, he can still qualify because the treatment is not correct. So this is a major, issue in terms of the accounting for M&A.
Let me tell you one thing.
Yes, sir.
The rationale,
Yes,
the rationale behind it is this, that when you purchase some part of the business, if you agree to pay more than the net asset value acquired, this is necessary to be treated as goodwill. For example, if the business you acquire, net asset value is 90 crores, and the seller is asking, I will give me 100 crores. So buyer also agrees to give 100 crores when you acquire. So this 10 crore has to necessarily to be treated as goodwill. There is no other way. And then this has to be shown in as goodwill. That is known as when you have purchased the goodwill. This is you have purchased the goodwill. That to show.
No, sir. Perhaps I was not able to add this. The issue which came up in that discussion was not per se about accounting for goodwill. The issue which came up was the way companies are actually using this, disclosure requirement to give effect to the reserves, change the capital reserve or revaluation reserve into revenue reserve, and then use it, for distribution of. No, but sir, in a lot of schemes this is happening, sir. That was a concern. And the other aspect in, sorry?
A number of companies have done this.
Yes, they have done it. And the issue which was there was that what should we do? Should we bring that out in the standard on goodwill? That was what I was saying. The other aspect why they thought about drafting a standard goodwill was because of the other different treatments. As I mentioned, AS 14 says that you amortize goodwill. AS 21 says that it does not say anything. There is another standard AS 26 which talks about impairment of goodwill, go to AS 28. So there were different cases where goodwill was appearing under different transactions. Some were not even written off. So that was the background to that, and within that, this issue came up.
This is a malversation under statute.
Sorry?
I think Indian Airlines and that Air India and International's malversation was there.
Yeah.
And other malversations are normally public sector undertaking type also.
Yes.
But normally private companies are not allowed this malversation under such issue. Is it?
Sir, the courts and so many private sector companies, the courts have sanctioned. I have seen myself. It is a big problem. So
this primarily happens because there are some companies which demand that out of this reserve they can later on use as a bonus issue. That is cleverly done. It's not otherwise required.
Sir, I was part of it.
And they get it. Yeah. They get it approved from the court. Once it gets
approved from the court, but the problem happens on the company as well as on the auditor for following such practice. I have been part of the FRRB where we specifically looked at such treatments.
But when it is done very shrewdly and cleverly in consultation with the professionals.
No comment, sir.
Even regional directors make an objection to this. Yes. And yes, regional director will not permit. And the second, the new Commission Act 2013, the definition of reserve.
Sir, here if you see, I just mentioned here, this section is not notified yet. It says no compromise arrangement shall be sanctioned by the tribunal unless the certificate by the company auditor has been filed with the tribunal to the effect that the accounting treatment, if any, proposed in the scheme of compromise is in conformity with the accounting standards prescribed under 130. So they brought this in, it has not been notified yet.
But the definition of free reserves under 243 has been clearly mentioned. And the regional director nowadays they are taking a certificate from the chartered accountant.
No, definitely there is because that is in case of listed companies.
No, not even in the...
Yeah, so they are doing it, but there is no statutory force there. They are requiring, but now they want to bring a statutory force. That is a major issue.
The rules बनेंगे, अभी रूल बनेगा, तो amendment नहीं हुआ।
हाँ नहीं, अभी
not in operation. 43 is not
Under the listing agreement also they require you to give a certificate.
This clause 24 I have just proposed.
So this we covered, the goodwill we had covered. Okay. So briefly, what I just want to conclude on AS14 by saying that it is a standard which has actually outlived its significance. Changes are required. I mentioned you know, in case of pooling of interest, you allow both pooling of interest as well as business purchase. It does not cover demerger, although even the international standard does not cover demerger. So I have this, I mentioned, it is there in the presentation. I will not spend too much time on it, but essentially demerger specific accounting is being done without any guidance to as provided in any standard. So there is no standard. AS14 does not cover demerger. It is purely a tax-driven transaction, part of the M&A transaction. So demerger essentially is where all property is transferred. The resulting company issues consideration shares. Shareholders not less than 75% are holding shares in the resulting company. So this is a demerger. Again here, the challenge is that the difference, because there is no standard, it will either go to a capital reserve or a goodwill. So I have a slide also here, which shows how the accounting entries, will be passed. So there is a company, it's a demerged company and the resulting company. So in one company, there will be because you are transferring all your assets, liabilities as it is, and the other company is the one where it is going. One place you will have a capital reserve, in the other case you will have a goodwill. What have we not done is we have not shown issue of shares. If the issuance of shares is there, then obviously there will be an issuance of shares, the goodwill will go up by another. So let's say 10,000 shares is the value of the share which is issued, the value will go up to 14,000. So this is the clause 41 requirements in terms of disclosure, which is there for listed companies where you need to disclose, and again here the challenge is a lot of companies are not disclosing. We found so many balance sheets where proper disclosure has not been made, reference has not been made by the auditors also. These are some of the other disclosures. So I quickly move on to just two aspects in the consolidation, where because you had a regulatory aspect, and the issue there is, if you remember the earlier chart which said that if you take more than 51%, you take control. The problem now has come because of the definition which has come in the Companies Act as compared to what is there in AS21 in terms of control. Anybody would like to share what is the difference there?
No, control means although share may not be 51%, but decisions are taken by that subsidiary company or associate company, so that will be controlled.
No, that's fine, sir. The essential difference is that voting power has been left out of the definition of the Companies Act. So it talks about shareholding only. So if actually control is based on your voting power or your ability or power to control the board of directors. This is the only two ways in which you can have control. But the Companies Act has got a fiction where it says that even if you are holding 51%, and it does not talk about equity, it includes preference shares also. So even if you are holding preference shares, the problem is that somebody who actually has control because of voting power, so there are, since you deal with so many agreements, structures, there could be somebody else who's having control also. So whether both will consolidate or not. So this is one of the aspects. Same problem is there in the definition of associate also. Technically the associate definition in AS23 or even AS18 talks about significant influence. So if you have significant influence and you hold 20%, between 20, more than 20%, but less than 51%. But it talks about control of 20%. Now technically you cannot have control. How can you have control of 20%? So this is again a legal drafting or whatever. The challenge, what I want to highlight is on the accounting part, which I will just cover.
My appeal to you is,
Yes, sir.
don't make the company more complicated by introducing a new concept. It's already very complicated. You are going to
No, he is helping us to account.
Sir, I would be very pleased if I can help.
No, both institutes must sit together and the
I am willing to do that, sir, anytime. I have been, I will, if you can get that done, sir, I will be more than happy.
I was talking to Mr. Jayashree, all three institutes sit together and they make the business. If you want to do business to be done easily, then things must at least what they have done now, 185, 186, 74. You want the business to be done or you want the business to be closed?
Yes.
सर आप ये बताइए, अगर मेरे पास सिर्फ प्रेफरेंस शेयर की होल्डिंग है,
Why is it happening? Because we professionals, I have been in the Institute of Company Justice, we have created a lot of problems for our. Now there are no solutions. Now, then once, then now, all industry leaders, they are going to the Ministry of Finance and Corporate Affairs and others. Instead of asking you give us power, you give us code, they are asking you make the company that simpler rather than complicated.
Sir, we will discuss that. I have lot of issues. मैं आपको जो बता रहा था, just close on this. आप ये देखिए, supposing you have
This standard 14
हाँ जी,
are primarily based on the conventional method of accounting by which we were teaching evaluation of adoption and the other in the average teacher and doctor.
Yes, sir.
Continuously chartered accountant institute. So that is a simpler method which you are doing. But now you like IFRS has come. To that method you will show it.
वो मैं बताता हूँ सर अभी.
When you are teaching valuation, I have done for years. Now, what our members were feeling bit uncomfortable. I did not want to raise that time. I kept my just observed discipline on myself. It was such a good talk, but
Yeah.
people could not appreciate it. Why? Because he is not a teacher. As a teacher, you should have said that these are the methods, this is applicable to this is applicable to that.
Sir, Rajiv ji is very passionate about valuation. He's one of the best teachers I know.
I
Yeah.
heard. It was a very, very,
Yeah, he's.
very well intelligently talked about what people want. Income approach, what is income approach, where income approach should be applied, where market approach should be applied, where asset approach should be applied.
So suppose because of the fact the Companies Act today defines, control based on shareholding and total shareholding. So I can even have a control by preference shares. If I have a control by holding preference shares, how will I consolidate? I don't know. How will I consolidate? Because I need to see my share till I get it. My only right in preference shares is preference dividend. I don't have a right on the equity. How will I consolidate? So I'll leave that with you. I'll now just move briefly touch upon three aspects. One, the new, IFRS, which
And
perhaps we feel.
that preference here for all purpose and IFRS is a debt.
Yes.
But here you are saying
Exactly.
that control.
Exactly.
This is shocking. I mean, these are all different principles.
In fact, I have also consolidated balance sheet just for disclosure, so you can, see how minority interest. Because I was told, to display this, where minority interest will come both under equity as well as, in your the P&L and how that is done. I'll skip this and I'll quickly come to business combinations. And in this, the main difference is that this is business combination. Now, when I showed you that chart, initially the investment, the joint control, then the consolidation, everything. AS 14 does not cover any and every acquisition. It only covers amalgamation. Whereas this covers business combination. So any acquisition, any purchase will be covered under this. So there will be, it prescribes what. So that is the first thing. Yeah. Second, it talks about clearly, it identifies the first thing which you need to do in this is identifying the acquirer and acquiring. So a transaction where let's say Tata Chorus, who's the acquirer, who's the acquiring? Who's giving. So there are different conditions given. Who's giving cash, who's in a dominant position, all that needs to be done. Then business, it has to be a business. A business is defined, business is a defined term. So if if for instance there is a company which has an in-house, let's say an outsourcing department, it may not be a business for that company because it does not generate cash. But when it comes out, it may become a business for the acquirer. This is covered in, such transactions are covered in IFRS 3 as well as Ind AS 103. Then it is only purchase method. There is no pooling of interest. And it talks about, sadly sir, we are moving towards fair value, so it only talks about fair value. And fair value, everything fair value. Fair valuing your assets, liabilities, even contingent liabilities. So you can, take a view that, this liability is contingent, but you take into account what could be the probability, and on that basis you can work out the, the values, the net asset value, and then decide upon the purchase consideration. So it's all based on, and then, so essentially what happens is that you have a purchase price allocation. You have a price which is decided, you will take into account fair values of all, and you will allocate your purchase price, accordingly. This helps in my accounting for these assets and liabilities in my books, and then I can, depreciate them correctly. A very interesting aspect here is the contingent consideration. I did, when I was covering the aspect on consideration, I covered the aspect where it is probable, right? In this case, you could have a consideration which is contingent consideration is contingent upon achievement of something. So company says, okay, today you give me a lot of these tech companies, you are aware. Yeah, there is an earn-out. So in that case, you can have that, okay, in the next 1, 2, 3, 4 years, I will earn so and so. I will then, what I will do as an acquirer, I will fair value that, or I will take into account what is the probability and attach a value to that and add that to my consideration, right? And then do my purchase price allocation. So this is basically the difference as far as IFRS 3 or Ind AS. It will take almost half a 2-3 hours of detailed discussion to actually understand, but in this limited I just thought I would share with you these aspects. Then if quickly we just go through 2-3 questions. I had a long list of them just to understand. There's one more thing, sorry. Good. Now I mentioned to you that we had a slide where if the consideration was more than the net assets, you had what did you have? If consideration is more than the net assets?
Goodwill.
And if it is less? Capital reserve. Now what IFRS does is, IFRS 3 talks about a bargain purchase. So it says that if I have paid less and I have obtained more, what is it that I need to do? Take the difference to P&L. So that's called a bargain purchase. But what we have done is, because as I mentioned to you, these are converged standards. Ind AS 103 is converged, so we have made a slight difference. Departure. Bargain purchase under Ind AS 103 goes to another head in P&L, which is not the current PL. There is another head which is called other comprehensive income. It is called other comprehensive income, where items which don't directly get into the P&L, it's a P&L only, but it does not reflect in your current year's P&L. It gets parked there. It's a parking place, but still it's an income, other comprehensive income. From there it goes to capital. So that is the distinction between IFRS 3 and Ind AS 103. So we have still retained, I think we have still been a little conservative in saying, and this was debated endlessly with IASB. They were saying, no, it has to go to P&L, you cannot. But anyway, I think perhaps good sense prevailed. We'll learn later on that it is not taken to P&L, it will go to capital reserve ultimately. So these are the this main issues as far as IFRS is concerned. So, okay. So just 2-3 questions if we can take here, just to understand further. We did not cover. So the question is that the appointed date, I remember you were discussing about appointed date and all. So appointed date is 1st April 2014. The order is received on 15 May 2015. The accounts have not been finalized. Can I account for this in my 14-15 accounts? What would be your view?
Yes, we can.
Yes? If yes, then why? If no, then why? It's not a multiple
My
choice.
accounts are open, it has not yet been audited and finalized. I can very well merge the two balance sheets
Yeah.
and get it audited because my cut-off date or appointment date is 1st April 2014.
Okay, very good. I'll tell you an interesting concept here. Anybody else? Because this is an accounting concept. I just want to see if, and anybody else like to share why we can, or if any other view is there, any other alternate view, that whether or not.
This is the only option.
Only option? And you say still because
2014 balance sheet has to be, because 2015 balance sheet has not been completed. So, based on the 2014 balance sheet, we will work out everything for the 2015. This order will be taken into consideration before finalizing this balance sheet.
Order is after 31st March.
yeah, that is what I wanted to hear. That is what I wanted to hear. Absolutely.
It cannot be merged. It will be merged in 15.
Very good, very good. That is what I wanted to hear. Exactly. And that is why I thought I will address this issue.
Yes, sir.
Absolutely, sir.
Even so,
Hats off. But so you are saying it's an adjusting event, since you know. And can you explain why, sir?
the count has not been finalized.
No, but since you said it's adjusting, why would you say it's an, what is, so anyway, let me take off from there. There is an accounting standard 4, which is events occurring after the balance sheet date. Firstly, balance sheet date will be 31st March. So it talks about whether the events occurring after 31st March, any time or after the balance sheet date, are adjusting events or non-adjusting events, right? And adjusting events are those which require adjustment. The only thing is that the conditions have to be existing as at the balance sheet. You are only provided additional evidence. So they provide you additional evidence of conditions which existed at the balance sheet. So the conditions are already there. Your appointed date is 1st April 2014. Supposing your appointed date was 1st April 2015. Technically assuming that I stretched and my balance sheet was in June 15, right? I got the order. Would I still do it? No, because the conditions did not exist as on 31st. So this is an adjusting event. Let's leave it at that. Yes?
What happened is, company could intentionally ask for the court order which they may include it 1st April, because they don't want to finalize the account on 31st March, and they can get 1 year. So the next time they finalize it, instead of treating them as
That is possible. The only caution here, sir, would be
that
that I
remain the intention of the company, but what they want from the court, because the court order gives them all kinds of reliefs.
Yeah.
You cannot get otherwise.
No, but I'm sorry, sir. I think what you're saying is that the company can, intentionally get, Yeah, so a lot of companies do that, sir. But I'm only talking about a case where it is received, then you will be required to adjust it. Only thing which and if you do want to account for it, then the best course is to file it with the, at least file the same with the ROC also. That is my suggestion.
The ROC and also
With the
notes on accounts, you got disclosure.
Yeah, disclosure
to be made.
Disclosure has to be done, sir. Everything. That definitely. Okay, so in case just the next, I think 2 questions I'll take.
One problem will come, but say these quarterly results which you are giving in case of listed companies, it will create some problem.
सर ये next question वही है. In fact, demerger का आप देखिए, उसमें मैं ये पूछ रहा था कि demerger is appointed date again. So
What happens is a limited review.
हाँ जी.
The limited review will have to be up to 31st March. It cannot be for the
31st नहीं मैं वही सर देखिए question देखिए demerger के लिए इस पे perhaps then you can shed light on this कि 1st April to the order of court is received only on 1st April 2000 February 15. तो अब इसमें 3 quarter निकल चुके हैं. और क्वार्टरली रिजल्ट्स कंपनी पब्लिश जून चला गया, सितंबर चला गया, दिसंबर चला गया। तो मैं जब मार्च में एडजस्ट करूंगा तो पूरा का पूरा मार्च में करूंगा ना एडजस्ट।
All of the adjustments have to be shown in the last quarter.
Last
quarter.
Absolutely. Well, that is what I wanted to.
With the notes on accounts.
Yes.
To be 135, chartered accountant will also notify. If it is to be qualified somewhere, then the qualification directors have also to comment on that.
Absolutely, sir. Absolutely. The reason why I thought of presenting it is there have been cases where companies have done it in the earlier quarters also. So that is the reason I thought I will highlight this. ये देख लेते हैं एक बारी। Can goodwill and capital arising from be set off and disclosed at gross or net? मतलब डिफरेंट कंसोलिडेशन है आपकी, कहीं आपका गुडविल आ रहा है और कहीं पर कैपिटल रिजर्व आ रहा है।
अगर नेटिंग भी कर दो तो नो हार्म, बट
नेट कर सकते हैं।
डिस्क्लोजर में देना पड़ेगा।
बिल्कुल सर। और
I think this is okay then.
yes, this is something which I did not cover. In fact, principally मैंने आपको बताया कि अगर मैं एक्वायर कर रहा हूँ एसोसिएट, जॉइंट वेंचर या सब्सिडरी, राइट, उसके अंदर अगर मेरा इंटेंट है that it will only I need to dispose it of. If my intention is only to dispose it of in the near future, right? Then I will neither do equity accounting, nor do proportionate consolidation, nor do consolidation. This is that question which answers it, and that is just provided in the standard, right? Because the intention is not to hold it for a long period. So I will merely take it as an investment.
It may happen in many companies because now there are 2 layers of subsidiaries. 2 layers of subsidiaries in future going to be. Earlier you could have many layers of subsidiaries, and now layers have been reduced. So many companies may try to sell off or
नहीं, but sir उसमें इशू जो अकाउंटिंग में इशू है, जो स्टैंडर्ड्स के अंदर कि just because I have 20% or I have 50% or 51%, I necessarily need to do equity accounting and consolidation? No. If the intention is कि मेरे को ये मैं ले रहा हूँ और मैं आगे बेच दूंगा, कि मेरा बिजनेस ही है, यहाँ मुझे पता है कि मैं ये लेके आगे बेच दूंगा, फिर मैं वो अकाउंटिंग नहीं करूँगा।
that subsidiary doing non-core business, so I would like to get
So I think with that I will close my presentation. Thank you very much for your patience. And since this is my first time with the ICSI, I please apologize if there are certain aspects which I have missed out, because I am used to talk to accountants, but I love to come here again and share my thoughts. Thank you very much. Thank you.